Why do some people build incredible wealth while others struggle financially for decades? The answer isn't just about how much they earn, it's fundamentally about how they think about money. Welcome to This Explainer. Today, we're going to uncover the core principles that separate true investors from everyday consumers. We'll explore the data-driven mechanics of why the wealthy continue to grow richer over time, looking at the daily routines and long-term investing strategies that actually forge financial freedom. By the end of this, you'll see exactly why two people making the exact same salary can end up with drastically different financial futures.
It's a phenomenon we see literally every single day, right? Why do some folks manage to build lasting financial freedom while others, who work just as hard, sometimes even harder, stay broke for life? You know, the common misconception is that the wealthy simply have higher-paying jobs or just got incredibly lucky. But the data gathered from self-made millionaires and billionaires shows us something else entirely. The ultimate difference doesn't come down to the size of the paycheck. It simply comes down to what they choose to buy with that paycheck. Basically, wealth is not determined by income. It's determined by capital allocation.
To really wrap our heads around this dynamic, let's look at a tale of two futures. Imagine two friends. We'll call them Friend A and Friend B. They are the absolute perfect control group for our explainer today. They grew up in similar neighborhoods, went to the same university, graduated with the exact same business degree, and landed entry-level roles at the exact same firm. Their starting salaries are a perfect mirror image, so they're standing at the exact same starting line. This means any divergence in their future wealth is going to be purely the result of their personal financial habits and decision-making over time.
To establish this baseline, let's put a number on it. Both friends earn exactly $5,000 per month. Now, this is a very deliberate number because it shatters the illusion that a massive multi-million-dollar income is required to build wealth. $5,000 a month is a solid average professional salary. It's enough to live comfortably, sure, but it's also a strict boundary. It requires disciplined budgeting, it tests your financial restraint, and really forces a choice between instant gratification and long-term planning. Their income is identical, so the divergence in their lives is about to happen solely through their purchasing habits. Let's examine Friend A. Every month, that $5,000 hits their bank account, and boom, the consumer mindset immediately kicks in. What do they buy? Well, they immediately upgrade to the latest phone, prioritizing a fleeting tech trend over savings. They buy expensive, brand-name clothes to project this outward image of success to their peers. And they take out a heavy, high-interest loan for a luxury car they really can't afford. Their money goes entirely toward luxury goods and things bought on credit. This is the ultimate trap of the modern consumer, literally spending tomorrow's time to pay for today's depreciating status symbols. And it leaves absolutely nothing left over to build a foundation for the future.
Now, contrast this behavior with the second friend. Friend B operates with a highly disciplined investor mindset. When their $5,000 arrives, they live intentionally below their means. They drive a modest, reliable vehicle and skip the designer clothes. Instead, they channel their remaining income directly into something entirely different. They buy stocks and index funds. They invest capital into small businesses. They acquire income-producing investments. You see, Friend B has mastered the crucial habit of delaying gratification. They're taking their active income, the money they literally traded their valuable time to earn, and systematically converting it into assets that will eventually work totally independently of their time.
We call this the Great Divide. In year one, Friend A and Friend B are virtually indistinguishable to anyone watching. They drive to the same office, making identical incomes. But by year 5, well, those divergent purchasing behaviors are aggressively compounding. Friend A is drowning in high-interest debt, constantly stressed out about making the car and credit card payments. Meanwhile, Friend B is seeing their very first dividend checks roll in, experiencing the early momentum of financial freedom. Fast forward 10 years, and their lives look completely different. Friend A is trapped in an exhausting cycle of paycheck-to-paycheck panic, unable to ever stop working. Friend B? They've achieved total financial independence. And the exact reason why brings us to our next concept.
Section 1. Assets versus liabilities, the definitions that dictate destiny.
Okay, let's start with a liability. Simply put, a liability is something that takes money out of your pocket every month. And this right here is the tragic flaw in the financial planning of the poor and the middle class. They consistently spend their hard-earned income on things that actively lose value over time, all while requiring ongoing maintenance, insurance, or interest payments. A car loan takes money out of your pocket. A brand new luxury vehicle loses a massive percentage of its value the second you drive it off the lot, yet those massive loan payments stick around. Credit card debt takes money out. Expensive gadgets that become utterly obsolete in 12 months, they take money out. They are financial sinkholes that require you to keep working just to sustain them.
Now, the absolute core of this entire philosophy is understanding the exact opposite. An asset is something that puts money into your pocket. It really is that simple. Wealthy people focus relentlessly on acquiring things that make them more money. They are intensely disciplined about this, cultivating a daily habit of evaluating their capital. Before they purchase anything significant, they ask themselves some rhetorical but vital questions. Will this purchase generate cash flow? Is this going to appreciate in value over the next decade? If the answer is no, they objectively recognize it as a liability, not an asset, and they just walk away. This strict adherence to acquiring assets is the foundational bedrock of literally all self-made fortunes.
When we compare these choices conceptually, the divergence is perfectly clear. Phones, clothes, car loans, and credit card debt drain wealth, but stocks, businesses, and real estate build it. You know, society often tricks us into thinking that someone driving a heavily financed luxury car and wearing designer clothing is inherently wealthy. We constantly confuse looking rich with being wealthy. But true wealth? It's almost always invisible. True wealth is the diversified stock portfolio sitting quietly in a brokerage account. It's the ownership equity in a thriving private business. It's the real estate deeds locked in a safe. The wealthiest individuals often live completely unassuming lives, continuously pouring their capital into the assets that actually generate real financial momentum.
Let's look at exactly how different types of assets physically put money back into your pocket. When you consistently buy stocks or index funds, they often pay dividends, which is literally a cash payout just for owning a share of the company's success. When you own or invest in a business, it generates ongoing profits that you can withdraw or reinvest. When you invest in real estate, it produces monthly rental income from tenants. Every single one of these avenues represents a brand new income stream flowing directly to you. It's cash flow that arrives whether you get out of bed that morning to work, whether you're on vacation, or even whether you're sleeping.
Section 2. The Secret of Wealth, the Engine of the Rich.
We call this the compounding engine. It's this brilliant, perpetual three-step loop. Step 1, the wealthy use their initial saved money to buy assets. Step 2, those assets generate even more money, creating cash flow like dividends, business distributions, or rent. And step 3, which is absolutely crucial, instead of spending that newly generated money on a luxurious lifestyle, they rigorously reinvest it to buy even more assets. This allows their wealth to grow through compounding. The snowball effect here is massive, because next year, your original investment and your previous earnings are both working for you simultaneously. This is the exact mathematical reality behind how investors like Warren Buffett built historic fortunes. It's not about a quick, lucky trade. It's about decades of letting a compounding engine run uninterrupted.
And this illustrates the ultimate paradigm shift in personal finance. The rich don't just earn money. They buy assets that earn money for them. Most people are, unfortunately, playing the completely wrong game. They're trying to figure out how to work more hours, take on extra shifts, or secure a slightly higher wage just to afford better liabilities. The wealthy, however, are figuring out how to acquire more assets so their accumulated capital can take over the heavy lifting. It's a fundamental psychological shift from being a laborer who trades time for money to becoming an allocator of capital who leverages money to essentially buy back their time.
Which brings us to a foundational quote from our source material today. Money starts working for them instead of them working for money. This perfectly encapsulates the investor's journey. When you buy a liability, you are making a commitment to trade your future time to pay for it. You're basically sentencing yourself to work for the money. But when you buy an asset, you are effectively deploying a tiny, tireless army of dollar bills to go out into the global economy, work 24 hours a day, 7 days a week, 365 days a year, and bring back more dollar bills to your pocket. This army doesn't need sleep, it doesn't take vacations, and if managed correctly through sound investing education, it will literally never stop growing.
So we return to the choice between friend A and friend B. It all comes down to the decisions you make with your cash flow today. Every single dollar that enters your bank account represents a choice between instant gratification and long-term freedom. The divide between struggling and thriving is built entirely upon the daily discipline of acquiring assets over liabilities. So look at your own bank statement this month and ask yourself a really difficult but necessary question. Are you building a tireless army of assets, or are you just funding your own liabilities? Thanks for joining me for this explainer.